Everybody, welcome to the morning market briefing. It's Monday, October 3rd, 2022. We are starting Q4 right now. Futures up quite nicely. We've got S&P futures up about 0.5%. Dow futures up 69 basis points. So nice number there. NASDAQ up 0.25%. Oil's up about 4.5% at $83 per barrel. Ben, welcome back. How you feeling?
Thanks. It's good to be back. I'm feeling energized, refreshed. Ready to go.
He's ready to rock. We're going to fix the market. Ben's back. We're looking at green right now, so hopefully that's the case. Lots of turnarounds over the course of the weekend. The UK tax rate, which we talked about really at length last week on the calls, they're deciding that they're not going to move forward with the removal of the 45% top rate of income tax. Ben, big reversal there. What do you think kind of drove that, other than the fact that we were getting really inconsistent signs from everyone involved?
Yeah, I think Liz Truss has just come into the British Parliament at exactly the wrong time. I think Boris Johnson really did not do her any favors in what he handed her. It's just absolutely chaotic what's going on right now. They're trying to battle their current malaise with stimulus, which is different than what they did in the aftermath of 2008, where they had a propensity, what they called the age of austerity. Was when I was starting in this business, that's the whole term, what they were doing, the age of austerity. Now they're doing the exact opposite. So it's actually good to see that they're removing this proposal. I think they need it because the pound has certainly weakened. The pound has strengthened significantly over the last week, over the last really 5 days. Thankfully, after I left, it strengthened about 7-8%. So that's good news for the British. But they really need to see some calmness in their bond market right now. And I think the Bank of England's trying to do that.
Trying to bring some stability. I think that's in some regards what everybody's looking for. But meanwhile, we do have an emergency Fed meeting today, Tom, 11:30. What's the goal? What are we listening for?
So that's a great question. What they're saying is they're going to, quote, review and determine the review and determination by the Board of Governors of the advance and discount rates to be charged by the Federal Reserve banks, which essentially is they're looking at what are they going to do on hikes. There's a lot of different information coming in that I think is pushing this. I think one is, the narrative has always been essentially that the Fed is going to raise rates until something breaks or inflation comes down. And I think we've actually kind of hit the if something breaks point more quickly than I think people anticipated. But those things aren't necessarily in the U.S. markets. But, we saw the Bank of Japan really struggling. Bank of England now is very much in hot water in terms of managing their monetary policy. And then on top of that, on Friday, we had the Atlanta Fed puts out the GDP Now number, which is, sort of their live estimate of what GDP is going to be in the current quarter. And it moved up. And it didn't move up just a little bit. It moved up a lot. So it indicated that the economy is re-accelerating. So we had that jobs report or initial jobless claims where almost nobody got fired last week. So the jobs market is still intact. And then we had GDP Now accelerate from 0.3% estimate for Q3 all the way up to 2.4, I believe, on Friday, which is a massive upshift in the market in terms of economic activity. And so what the Fed is doing is essentially not working. They're not hurting the jobs market. They're not slowing demand, and they're not slowing the economy. Meanwhile, the stock market continues to spiral. That we're seeing, functional problems in other central banks. And so I think the real reason for this meeting is for them to come together and either get an idea for what needs to be done, how they have to change policy, because what they're doing isn't working, and what it is doing is making the economy somehow reaccelerate while making everyone's life more miserable. And so it's an interesting conundrum we're in.
What you're seeing is that really have an impact on financial markets, on banks, and less of an impact on the economy, which seems to be actually holding in okay. So I think this is a really interesting time from the Fed, because usually you would think that financial markets would inform the economy, and then potentially vice versa, especially when you're talking about the cost of money. You increase the cost of money, you reduce the size of the economy, but that mechanism is not functioning the way the Fed would think it would.
Yeah.
And so I think it's pretty interesting that they also need smooth monetary policy and smooth functioning of the financial system. And right now they're throwing that in jeopardy with the rate hikes.
Yeah, and it's interesting. I mean, we're getting ready for macro presentation here in a couple weeks. As we were working on the presentation last quarter, I remember thinking and even answering some questions at the presentation as it related to, the economic slowdown, how long it could last. And it felt like at the end of June, we had priced in a recession on stocks. The market had priced that in, at least to an extent. I don't want to necessarily imply that it's a one-to-one thing, or that, you know exactly how deep a recession is going to be, and therefore stocks should do X. But it felt like you'd had a lot of pricing in. Meanwhile, the economy has continued to hum along, certainly much better than I would have expected. We've said it on the call a couple of times, but I would have thought unemployment would be significantly higher now. I would have thought, when you see the headline that Atlanta has revised, their GDP now forecast from 0.3, I was expecting a negative number, but it's significantly more positive than expected, and yet the market's lower. And so it's this odd kind of imbalance where there's all these unintended consequences. And to some extent, I wonder if the market's just pricing in doubt on the Fed's ability to execute. And I think that's a fair thing to be pricing in, but I wonder how much that's impacting stock prices almost in isolation and away from the actual economic data. We also have OPEC Plus saying that they're going to have a reduction of 1 million barrels per day. This is a big swing, Ben, and what could really hurt supply.
And it may actually be more than that. I mean, just a couple of months ago, we were talking about new supply coming onto the market. And now OPEC is looking at reducing that. The final announcement will be made Wednesday. But right now, we're looking for a baseline, a floor of a reduction of 1 million barrels per day, which again is about 1% of global oil demand. Think about it, about 100 million barrels per day of oil is consumed. What's notable here, too, is that this comes on top of the end of the releases from the Strategic Petroleum Reserve. Those releases are scheduled to stop at the end of this month. So at the end of this month, you may have 1 million barrels per day less supplied by OPEC and 1 million barrels per day less supplied by the U.S. through releases from the Strategic Petroleum Reserve. This doesn't even include potential restocking of that reserve. So what we're seeing is a significant decline in global oil supply. And right now we are seeing potentially some demand, destruction, especially in other countries, not just the US, but other countries. But right now, it seems like we may be turning the page on oversupply, not enough demand, to maybe demand is a little bit higher than expected, and maybe supply is going to be lower than expected. So it's not going to help inflation, though. And especially when you look at oil priced in other currencies. Remember, we have a very strong dollar right now, but because the dollar has strengthened 20% against some of these other currencies, oil is, from their point of view, 20% more expensive than it is here. So oil is still very elevated, especially priced in other currencies. And that is probably going to continue to be the case with these supply reductions.
On the individual company side, Tesla down 5%. Good production numbers, arguably the best production numbers they've had, but delivery numbers missed what the expectation was. They delivered 344,000 vehicles versus an expectation of 358. Again, good production, produced 366,000 vehicles. They're essentially calling this a little bit of a logistical issue, and things were on their way, and they don't seem worried, but the stock's down 5%. I think investors are rightfully worried, Ben.
Yeah, we're actually going to be doing a deep dive on Tesla, and we'll probably have an update for you on that in the market memo coming out this Friday. We have a pitch that we're reviewing on that. But yeah, I think with Tesla, the whole narrative is they have always been supply constrained. And they could just keep increasing production by 50% a year, and the demand was going to be there, build it, and they will come, so to speak. But that is not the case in Q3. Production actually exceeded deliveries. They said it's logistic issues. There was a bunch of in-transit inventories. They'll recover those deliveries next quarter. But I think that this does unveil some of the concerns that have shrouded Tesla in the past, which have been, what happens, who is ultimately going to buy these $100,000 vehicles or $50,000 vehicles or 75,000? There's a lot of money that needs to be spent in order to justify where Tesla is today and grow sales by 50% every year.
Google essentially flat, but they are pulling the plug on their Translate app in China, and they're discontinuing this due to low usage. But they seem to just be consistently taking steps to kind of remove themselves from that market overall.
Yeah, I think that's the narrative. They're just looking to get out of China, as a lot of companies are, a lot of sensible companies are. Some companies, like Starbucks, that's not the case, but that's probably because they've already bet too much on that.
Yeah, Starbucks is going to continue to flail there. They love it. It's their favorite story.
Yeah, they sell like 12 cups of coffee a quarter, and they get real excited about it because last quarter is only 11.
Yeah.
Credit Suisse continuing to just struggle. This is stock that's down 60% over the last year. It's down about 7%. Pre-market was down 12% earlier today. Ben, what's going on there?
Yeah, they need to raise some money. They're already looking at a big restructuring plan that's going to be announced at the end of this month. They're part of that is going to be selling assets. Their investment bank is absolutely hemorrhaging money. It's lost, I think, 250 billion francs, which is about 1 to 1 with a dollar. And their market capitalization is only $9.5 billion. KBW, an analyst outfit, says they need to raise $4 billion of capital in addition to the restructuring announcements that they've already made, which would be massive, massive dilution for their shareholders and would just continue this death spiral for the company. The problem is right now, a lot of the people who Credit Suisse does business with, they are saying, we will take our business elsewhere unless you give us more favorable rates. And this is making Credit Suisse less profitable. And it is kind of a situation where bad begets worse.
Yeah. I mean, I've read an article this morning saying that they were talking about rebranding because the name is so bad and so toxic that they're talking about changing the name to the First Boston Banking Group. So Credit Suisse, just like Bank of America started as the first bank of Italy, now we'll have Credit Suisse will now be the First Boston Bank. We just keep taking all of their banks. So they're like, well, people don't like the Swiss. We're like, why not Boston? It's like, oh yeah, everybody loves people from Boston.
It's very endearing.
Yeah, the nicest people on the planet.
Meanwhile, Putin continuing to lose some ground in Ukraine. A number of victories for the Ukrainian military, which somehow I'm consistently shocked that this conflict is still going. It does raise concerns as to how Putin's approach may change, but he's going to become increasingly desperate, and yet his military seems very incapable of securing a victory.
The organization of the military is extremely poor. I think the party line right now out of the Kremlin is that the 4 territories they have annexed, their borders have not yet been set yet. So they didn't really lose that ground to Ukraine in their minds. They just, it wasn't the border.
We weren't ready
yet.
Yeah. So the off ramp they have now is they're saying, now this is Russia. So you set foot in Russia, we're going to use nukes on you, which is like, I mean, what are we, 12? You know what I mean? Don't cross this line that I put there arbitrarily by attacking you. So I think that's the off ramp. I think he's going to say, this is Russia now. And unless you want us to nuke you, we're just going to keep what we've got left. And that'll be the end of the war, which, I mean, I don't know. I don't exactly know how that plays out, but it looks like Ukraine's going to join NATO, at which point, if they do have an incursion into what is now Russia, but used to be Ukraine, now NATO's involved. I mean, it could be, they're trying to set up World War III. I'm very hopeful that they won't, but
I'm increasingly hopeful they won't. I mean, it just seems like
they're not doing a good job of it.
Yeah.
And it doesn't help that when they put the annexation through, that China, India, and Brazil chose not to, they abstained from formally rebuking. So, whose team those 3 countries are, and they're very highly populated. So not great.
Yeah, it's just chaos over there. But we'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great Monday. Talk to you soon.